Hey, good morning, everybody. Hope your Saturday's off to a good start. Down in Florida today, and I am recording outside a little bit. You might hear some traffic from the road. I apologize for that. Just here, kind of helping my dad out, and he's up watching ESPN, and being in his 80s, he has the volume up quite loud. So I figured he probably didn't want to hear the background of Sports Center. Probably a little bit better to have maybe an occasional traffic sound than sports. But anyway, today it's a little bit of a hodgepodge. I just basically took a few questions that I've got recently from clients. Probably the biggest one, most pressing, was just the unemployment, but just some general questions. So it's not a real long one today, but we'll jump in and look at some of the slides. Okay. So one question I'm getting quite a bit is, all right, the big, beautiful bill. Obviously, a lot of different thoughts on that, depending on where you align politically. But people say, what do I think of it? I'm not, generally I don't like to talk about politics stuff, but this obviously is going to have a big impact on the economy. And I don't like this bill. For one reason alone, is just the amount of debt that it's going to add to our deficit. We're getting to that point where we have got to make some difficult decisions in order to bring down our spending. We're going to have to. And, this thing it's going to increase the debt no matter who's looking at it. Congressional Budget Office, which does not typically have a great track record, but every organization I'm looking at, this thing's going to add to the deficit. And this was sort of a chart I saw, kind of, looking at that if we do enact the bill, you can kind of see if we let the tax cuts expire, we don't increase spending at all, we're still projected to, by year 2055, to be at 166 times our GDP in government debt. And that's if rates don't go up either. I think that's using rates of like 3%. Oh, yeah, 3.8%. Sorry. It's right there in front of me. We'll hit a wall before we get to 166% debt to GDP. Now, a lot of people tell me, well, Japan's at 215% debt to GDP, and that's true. Their government is, but they also run a very large trade surplus. So they, as a nation, as far as their economy, they actually have savings. We don't. I've been talking about this for a while. We have a very large, trade deficit, which is essentially us giving our savings to other countries. So you can start to see, like, if interest rates are above 3.8, which they are right now, the 10-year just over 4.5. So if you added 1% to the interest rate, if you extended tax cuts, if you continue to keep our spending level where it is, at that point we'd be at 295% debt to GDP by 2050. And again, I think at some point the markets would force us, before we ever got to that level, to do something. And then if interest rates continue to go up, if we get 2% above that 3.8, if we get to 5.8, which it's quite a ways from where we're at now, but it's not that far of a stretch, considering we're going to have to pay more in interest if we're going to continue to run these deficits. It's getting to the point where it's looking really bad. So I don't like the fact that this bill is going to increase our debt this much. And that's the main reason. There's good things in the bill. I don't know why Congress continually has to put everything into one bill. Well, I think I do know why. Like if they put everything in one bill, and then if there's something for homeless vets and you're going to vote against it, they say, what do you don't like homeless vets? You don't want to help homeless vets? Kind of same thing here. There's things for increased ICE, so enforcement on that end. There's good things in it. So they can say, well, what, you don't want that? But, we have to start acting like adults, at least in Congress, and we have to start to realize that we need to get our spending down, period, end of story. I mean, it's going to start to have an enormous impact on us, because we're going to get to a point where either rates are going to go up considerably, which is going to have a big impact on the economy, or the Federal Reserve is going to just start printing money to buy the bonds to cap the rate that they pay, which at that point we end up getting inflation, which is going to have a massive impact on the economy. So, we're at a point where we could still sort of right the ship, but if we don't do something really soon, it's just not going to happen. And so that kind of leads me into the next sort of topics. Well, the next thing I wanted to talk about, I just got questions on. I usually get questions on, what do you think of the employment report? So they structured the headline so it wasn't too bad for the establishment survey, but the numbers aren't really looking good for employment in my mind. On Thursday, the first came out was ADP payroll numbers. So ADP looks at the private sector. ADP is an enormous processor of payrolls. That's what they do. Paychex and ADP are the two biggest payroll payers in the country. So lots of small businesses, even medium-sized businesses, outsource their payroll processing to ADP. And they came in, I think, at 16,000 jobs. But what you can kind of see that's sort of looking bad is just sort of the trend with the ADP numbers, dating back to really the end of 2024. So those numbers weren't very good. And what it's saying is, it missed big time because they were expecting 110,000 private sector jobs, and they only added 37 this last month. So that was a pretty big shock. Markets didn't like that, but they did like the establishment surveys. That's the government number that always gets thrown out. So, payrolls increased to 139,000, which beat expectations, which was, I think they were expecting, different groups anywhere from 128 to 134,000. So it was above expectations. Stock market loved it. And unemployment stayed at 4.2%. Now, I've talked about it before. There's two different ways that the government looks at unemployment. The establishment survey, again, that's sort of the more mainstream. And then the household survey. The household survey is literally them going to different households and just asking them, are you employed or are you not? So household survey is a little bit different, but typically over time, the two sort of track each other. There's a little bit of variability month to month, but from point A to point B over a year, they're pretty close. So both around the same. So you can kind of see what's going on with the payroll numbers here. They've certainly been lower this year than in the past, but if you look at it, this is sort of the headline numbers that we've had every quarter, every month. But so this is the sort of final numbers, but this is what they were doing this is adjusted for every month's adjustments thereafter. So the black is the actual numbers, but the kind of the orange part is what they initially had said. So you can kind of see a lot of revisions to the downside so far this year. So they come out with this number of 139K, but if things hold, we could see this thing well under 100,000 when they do next month's payroll. So really, I was kind of questioning it during the 2022-23, thinking, well, maybe they were getting a little political trying to help Biden, but it seems like they're still trying to probably help Trump here. I don't know, or maybe their methodologies just gotten worse over the years. I'm not sure, but a lot of different revisions to the actual numbers. Now, some months, granted, numbers got better upon the revisions, so that does happen. You can kind of see that at the end of 2024 that happened. But so far this year, they've had some pretty big misses from what their initial reporting has been. And as I mentioned, the household survey really is not very good at all compared to the establishment survey. And this is kind of, the household survey does some different population control factors. I removed that for the year in this chart, but you can kind of see what's happening month to month here as far as the numbers. But the big one, when you really start to look at it, that should alarm people, the household survey, they also break things down by total employment, part-time employment, and full-time employment. And the full-time employment so far this year has lost 870,000 jobs. So we're still seeing that trend that we have seen really for the past couple of years, where the job numbers may not be all that bad, but a lot of them are part-time jobs, and the full-time jobs are going away. Now, obviously, the vast majority of people, they want a full-time job. Oftentimes, there's benefits associated with a full-time job. And the other thing is they'd have to work a couple part-time jobs in order to really make up the same kind of income that they'd have with a full-time job. So, so this is a trend that's really, not very good. And so far this year, we've lost 870,000 full-time jobs. And the other thing that's a little bit different between a household survey and the establishment survey, the establishment survey looks at total jobs. So here again, if we go back, a full-time position is gone, and then that person has to do 2 full-time jobs or 2 part-time jobs. What that's basically saying, the establishment survey is say, hey, we've increased jobs by 100%. We've added a job there. Whereas a household survey just goes and says, are you employed? And they say yes. It doesn't ask, are you doing 2 part-times? You doing 1 full-time? It's just, are you employed? So the establishment survey, if we're adding just part-time jobs, which it seems to be, while it is true that you are adding more and more jobs, it doesn't necessarily mean it's a positive, because if full-time jobs are going away, that's not really good for workers. I think the thing that's a little bit more alarming is just the number of jobs that are job offerings that are in decline. So now we had a really good bounce up after COVID. So we're still kind of, job openings are still high enough to where they were pre-COVID. So we're still doing okay on that end, but you're starting to see this trend kind of accelerate, where job openings are declining every month. So if you look at continuing claims for people who are unemployed, they are going longer. It's taking people longer to find a job. So it's definitely something to keep on your radar. So I'm answering this question because I got asked a question, but also it plays into the next point that I wanted to talk about. A lot of people ask about the bond market and, what's going on at the bond market. I've talked about a lot, very volatile, and trying to say, when are rates going to start to come back down, or when's the Fed going to cut rates? Or, I think people are under the impression that this recent bump we had was due to the inflation. The rates went up because of that. And then we should get back down to where we were sort of pre-COVID or right after COVID, where we're getting back to, honestly, where we've been since 2008. I mean, since 2008, the Fed has really been pretty close to zero bound the whole time. But we may not be getting back there. If you look at this chart, This is going back to the early 1960s. And you can kind of see we've been in up until 2020, 2021, we were in a 40-year bond bull market, meaning rates were coming down pretty much the whole time. Now, obviously, from the late 60s until the early 80s, it was a horrible bear market for bonds with rates going up, getting up over 15%. But we've basically kind of been on that downward trend you can see there up until about 2021, and now we've spiked back up. Now, a lot of people will look at it and say, well, we're still only at the 2005 level for bond rates, and that's true. This could just be a normalization of it. But the fact is, we're definitely kind of broken a trend here, a long-term trend, so that even if they stayed where they're at, this would take a while for the economy to really absorb these higher rates. You've got mortgage rates over 7%. Car loans, a lot of car loans are double digits. So this does have an impact on the economy. So how do we know if rates may come back down? It's going to be hard to tell. And what's really interesting about this bond market is it's been one of the biggest drawdowns since basically 2021. It's been a long time of a bear market here for bonds. So, is this going to continue? Are we going to start to see rates come down a little bit here, or are they going to continue to go up? And it's hard to tell. The thing about bonds, it tells you a lot of different stories on it. So bonds generally tell you what's the growth and inflation rate expectations. That's what bonds usually do. So if you have very good economic growth, you're going to have higher interest rates. It's just a natural part of the economic cycle. So, sometimes bonds going up in yields is a good thing because it just means there's going to be more demand for that because the economy is growing. It also could mean more inflation. Now, inflation could be due to the fact that the economy is growing and you're going to have more demand. So if you have more demand and supply is stays the same, you're going to have inflation. But bond investors need to be compensated for inflation. They want to get a return above the rate of inflation. So if interest rates are higher, that's kind of telling you that inflation expectations are higher. So right now, are rates up there because we're getting very good growth, or are they up there for fear of inflation? And then there's also, which we've really never had in the past, is there's also the fear of defaults. When you buy a corporate bond or a non-government bond, that's something that you have to factor in. So the worse the credit of the company, the higher the interest rate that they have to pay to compensate for the risk. So maybe rates are higher right now because of our debt situation. And you can't find definitively an answer on that. You just have to kind of watch over time. But a lot of people are trying to say, well, let's get the Fed dropping rates. That'll help if they start to drop rates, because then everything will drop. But that's not necessarily the case either. This is a chart. The top is the federal funds rate. So that's the rate that the Federal Reserve sets. And then the bottom chart is the 10-year. Now you can kind of see when the Fed started dropping rates in 2024, they basically took rates down almost 2% total for 2024 to start of 2025. So rates were going down. Well, the thing is, though, over that same period, the 10-year Treasury was going up in rates. So even if the Fed was to start to drop rates here, that does not mean that the long-term 10-year or longer is going to also follow the way the Fed does. They are independent of the Fed. So again, what the 10 years looking at is more of economic growth, inflation expectations, and now we have to throw in there, not necessarily default, but they need a little extra compensation because of the massive amount of debt that we have. And I have gotten questions of, oh, Moody's downgraded us. What's that mean? I really don't take any of those three credit agencies for the worth. Ever since 2008, they've really been kind of useless. But it is true that we're bringing on more and more debt, and that's going to at some point demand higher interest rates from the investors, because one, they might fear that there's a chance that things will get worse and that the bond yields will continue to go up, meaning that their bonds are going to lose value. And then secondly, probably a fear that the Fed might step in and just start buying, bonds, which would cause inflation, which would detract from the bonds that you already own. Now, what's really interesting that's going on and kind of has me stumped is the dollar is usually pretty highly correlated with what's going on with U.S. yields. So if you look at this chart, U.S. yields is in blue. So this is government bond yields, 10-year Treasury yields. And then the red is the U.S. dollar index. So typically when the dollar is getting stronger, interest rates are going up, and then vice versa. But right now we don't see that happening. We see the dollar is actually getting weaker, but interest rates are rising. So my initial instinct is the bond market is expecting inflation. So if the dollar is losing value, that's typically going to be inflationary for us, because it's going to take more dollars to buy the same amount of goods and services. So it's inflationary. So maybe the 10-year is going up because it fears inflation coming. But it is kind of just strange to see such a deviation between this correlation. So it's something to kind of watch. And it's really not just the United States facing this situation. Probably the other biggest one that we should be watching, and I've talked about this in the past, is the Japanese government bonds. So they are now seeing something where their interest rate for their 10-year is now at 1.5%. And you can kind of look at this chart, and really they've been below 0.5% for a long time. This chart only goes back to 2015, but it's really been that way. Probably, I think they've been around 0.5% or lower since the early 2000s, maybe even into the 90s. Really, ever since 1989, when things crashed, they started bringing their central bank started buying bonds and capping the rate at which they paid. But they are now in that situation where the Japanese yen is under some stress, and there's so much debt now that bond investors are demanding a higher return. So Japan's in kind of an interesting situation as well. And you can kind of see their volatility on their bonds is about the same as ours. I've been talking with clients about this for a while. Like, we see a 0.5% move in the U.S. 10-year. Now, when you say 0.5%, it doesn't seem like much, but we see this in a very short term, like 2 or 3 weeks. That is a lot of volatility for the 10-year. That is really some serious volatility. And they're seeing the same thing here in Japanese bond volatility, seeing volatility levels they haven't seen even since 2008. So they're having some serious volatility. And the reason Japanese bonds are so kind of important to us is the yen carry trade. So basically, a lot of times what people do, they borrow, at Japanese yen and Japanese bonds, and then they'll invest in U.S. treasuries to get that difference. So, if the 10-year at the Japan is 1.4 and we're at 4.5, there's a spread there that you can make some money. So if you borrow a lot in Japanese yen. But if that starts to shrink, a lot of these people start to lose money. And what ends up happening is they have to close out their treasuries. So you end up getting forced selling in the treasuries, and you also end up getting the Japanese yen to go lower when they have to sell that back. So that's where it can get really start to hit us, is if we start to see the yen carry trade have some serious issues. So there's a lot. It's hard to tell what's going on with the bond market. There always is, but really one thing to probably watch is the unemployment in the 10-year. So that's sort of what I'm watching to see. If we continue to have some weakness in employment, or if it accelerates, typically what happens then is you start to see the 10-year come down. So that could bring yields down. The top part of here is the unemployment rate, and the bottom graph is the yield on the 10-year treasury. So you can kind of see every time that we have a spike in unemployment, what happens to 10-year treasury? They go down. So I'm really kind of watching that to see if maybe that's what we're looking at here, with the treasuries for the future of them. I'm still not sure. I don't know if we have enough growth to justify where the 10-year treasury is right now. And, inflation is moderating. So I don't know if we should still have the 10-year treasury at 4.5% or more. We'll see on that. But I think what could be the driver for future treasury rates is going to be the employment. So if we start to see some more weakness in unemployment, we'll probably start to see the 10-year treasury go 4.5%, start to come down a little bit. So, the rates coming down would be good for the economy as far as car loans, mortgages, things like that. But if unemployment's going up, is that really a good thing for the economy? It could be more of a sign of things are really slowing down. So, when people ask me what are the yields going to do, I suspect they're going to come back down, only because we're hitting a point where at 4.5%, it is having an impact on the economy. We're talking mortgage rates at 7%, car loans at double digits. I don't think the economy can handle much higher than that. But, so far it's still the rates are still up there, and they're not really coming back yet. That could be due to the massive amount of debt that we have, or maybe maybe the markets are expecting a lot of growth or inflation, but we want to watch. So I think if you watch both unemployment and the 10-year, I think you'll start to see a little bit more of a trend emerge. I do think rates will come down, but I'm not making any huge moves. We still have a lot of bond exposure in treasury bills, which are maturities of 1 year or less, because they still can pay a point, 4.3, and you don't have to worry as much about the bond volatility. But I've got, I've been saying slowly, really slowly, maybe once a month, I'll trade a little bit into some longer dated bonds, because I do think that I think things are slowing down, and at some point bond yields will come back. Although if we pass, bills that are going to add trillions to the debt, maybe they won't. I don't know. Maybe we have broken that 40-year bull market in bonds, and now we're going to face sort of an upward trajectory. That could be what's happening here too. The problem is you don't know until things get a little bit further down the road. Another question I get quite a bit from folks, we hold, gold is certainly a core holding, but people are saying, well, how about silver? What about silver? And if you look at what we call the gold to silver ratio, it's awfully high, meaning that right now silver is undervalued relative to gold based on historical averages. So a lot of people are buying silver under the assumption that it's going to have its day and really catch up and bring this gold to silver ratio back down to more of a normal level. Now, the thing is, like I said, I'm not sure exactly what's going on with interest rates, and I'm not sure what's really going on with the gold market. I suspect the gold market is doing so well because of the massive amount of debt out there, and it's starting to get to the point where there's people are running from bonds to gold for a store of value, because gold is a currency. It always has been, and it will continue to be that. So that is maybe what's going on with gold. And you see a lot of central banks around the world buying a lot of gold. That's probably to protect them from a weak dollar. Now, silver is sometimes seen as a precious metal, a currency, but it's also a commercial metal, and it's used a lot in various commercial entities. Everything from fillings, dental work, to heavy construction needs silver. So now some people say, well, that should give it even a better tailwind, because it's not only could be seen as a precious metal, it's also an industrial metal. That's true, but gold's move could be because it is a pure precious metal. It is a currency metal. Silver isn't. So I don't know if you're going to continue to see the gold silver ratio hold like it has in the past. It very well could, but I think there's something bigger going on with gold that's keeping silver sort of down a little bit and keeping this gold silver ratio awfully high. Now, this chart is awfully difficult to see, and I do apologize for it. But another thing that could be a good case for silver, so the white in all of these is silver, and the blue line is the price of gold. So you can kind of see every time we've had a big spike in the price of gold, the price of silver eclipsed it. The growth in the price of silver went far greater than the price of gold. So in the past, when this gold silver ratio corrects, it corrects big time, and the price of silver really goes up there. And I've seen people who study this stuff all the time saying, like, the price of silver is easily going to get to $50 an ounce based on the gold to silver ratio. So the past times we've had really big moves in gold, we've had even bigger moves in silver. And if you look at the very far right of the chart, you can kind of see that blue line of gold has gone up considerably, but the white line, the silver, has not. So a lot of people are looking at this and saying, look, if silver really starts to accelerate like it has in the past relative to the price of gold, this chart could get silver up to 70 or more per ounce. But the fact that if you look at this chart, when gold went up, silver kind of kept pace with it. Gold maybe moved first, but silver was still pretty close in correlation. We don't see that right now. We see the price of silver has gone up, but it hasn't kept pace with gold at all, which kind of makes me think that there could be something different happening here than just a traditional gold to silver ratio. But I'm not sure. If you wanted to add some money to silver, I think there's a potential for a good upside on it based on the gold to silver ratio. I also think that it could at some point really be seen as a precious metal, or at least something that holds its value relative to the US dollar. And you can see a good move that way, irrespective of what the price of gold's doing. So it could be a pretty good buy. Now, the thing you have to remember, though, this is looking at the price of gold and the price of silver based on its total return. The chart goes all the way back to the 1920s, but really, if you look from the 1970s, that's really when we started to see these two start to have some growth. So gold has clearly outpaced the return on silver. over the longer term. So yeah, we may have a gold to silver ratio that's a little bit out of balance right now, but you still need to focus. Gold has been the better investment because it does serve as a currency and a really true inflation hedge. So this would kind of lead me to believe that, maybe silver isn't really grossly undervalued as many people try to argue based on the gold silver ratio. But one thing that is kind of interesting is the gold miners are still relatively cheap compared to the price of gold. Now, miners have done quite well this year. I wish I had gone in earlier. I'm still waiting because they are extremely volatile, and I have been nervous that, the price of gold could have a pullback. But we're getting to a point where I can't control this thing. Huh? Okay. We're getting to a point where we're starting to see the ratio between miners and gold start to have a little bit of a breakout. And usually gold miners do trail the price of gold. And they usually, just like silver, kind of catch up and go beyond what the price of gold would be. So that is one area that I think there's some potential there. And if you go back the last 3 years, gold has done way better than the gold miners have done. So I think there's some potential. If you're looking for something to go beyond gold, maybe rather than silver, maybe look at some of the gold miners. Because obviously, if the price of gold is up there because it's a precious metal and a currency, maybe silver doesn't track it, but the miners are going to because they are actually producing the gold. So if everything they pull out of the ground is worth a lot more money, they're going to make more money. And I did a presentation probably 2 years ago on miners, and they're not like they used to be. They're actually pretty well run, pretty good, solid fundamentals on them. They used to be kind of, Wild West, in very scary areas of the world, and they're highly leveraged with tons of debt, and they've really kind of changed that a lot. So I think this is probably an area, and I'm going to just ease into it really slowly. But it does seem to be at a point where it could break out, and we could see, if the price of gold stays where it's at, we could see the miners do pretty well. Excuse me. Okay, last thing I've got was, this is just a chart I saw. I've got a couple clients that have been looking to buy RVs. One recently finally got good pricing on it. And it is a pretty good indicator for economic. People are buying RVs. That's usually a sign that the economy is extremely so you can kind of see from this chart, we are seeing a pretty drastic reduction in purchases for RVs. Now, there's a lot of little things that could go on with that. It could just be there's been a lot of RV sales, so maybe it's just a natural slowing. But typically these things do tend to slow before the economy slows down. Sales do. Just thought that was an interesting chart. Like I said, I've had a couple of clients that are looking to buy, so it could be a good time to do it if you're looking to buy an RV. And finally, we always finish with our little disclaimer that you could read if you are not a client. Okay. Why are you buying foreign ETFs? So yeah, I've got a couple foreign ETFs. One of them's of a developed market. So this is going to be Western Europe, Japan, Australia, New Zealand, Singapore, more developed, and it's dividend focused. So that the ticker symbol is DIVI. It's a Franklin International High Dividend ETF. So, I mean, it's yielding over 5% right now. And the big reason we're starting to see international outperform the U.S., at least so far this year. And I've been talking about this. If you're going to look at value, if you're a value investor, foreign is a much better place to be. So the price to earnings for the U.S. stock market roughly is at 22, 23, whereas most of the developed international markets are, a lot of them are close to 10, but in aggregate, I think it's like 14. So a lot cheaper. And if you look historically, we have periods where international does better than the U.S. and vice versa. And really, since 2009, the U.S. has dominated international. So at some point, that's going to turn. And a lot of people argue, well, hey, but the U.S. is so much more of a dynamic economy, so more entrepreneurial, and I completely agree with that. It's not necessarily an indication of the economy. It's more just buying stocks on the value you get, because we're basing on actual earnings of the companies in Europe and actual earnings on the companies in the United States. And again, your return over time is based on what you pay for those earnings. So if you can buy earnings at lower levels, you should, in theory, get a higher return over time. So it's a little bit of a value play, buying things that are cheaper based on actual earnings, and then also just the cyclical nature of markets. I mean, we're talking, 16 years now, 15 years now that U.S. has been dominant to international, and those things tend to switch. So far this year it has, but 1 year is certainly not a trend. The other one that I like is it's a little bit more focused. It's on India indirectly. India is an economy that is absolutely starting to boom. They're starting to really grow. And I've actually got an interview that I'm processing the video. It's a little bit older video, but I'm getting it processed. I'll show it to you. And it's an interview of the gentleman that runs the ETF, the India ETF that we're invested in. And he just makes the case for why India, and also how his fund is a little bit different. So India, if you think of the United States, our growth path to where we're at now, to the point where, we order food on our phones, we don't go to stores, everything's cellular based or Wi-Fi, everything's, we went from Sears catalogs to shopping malls to eventually getting to where we're at today. Well, India is just bypassing a lot of it and going straight to the mobile part of everything. So all of their new companies and developments are all going to be the Amazons, the mobile companies, all of that. They're going straight. They're skipping all the other stages that we went through, and they're going straight to a tech platform for their economy, and they're starting to see more of a consumer economy. So this ETF focuses on the companies that are providing the services. They're trying to find the next Amazon, DoorDash, all of those kind of, Netflix, those things that are in India. So it's kind of a growth play in a country that is growing awfully fast. And I'm not doing other emerging markets right now, mostly because, China, I never trust China's numbers, and China is in a real economic funk. And usually most ETFs with emerging markets are going to be 20% China. The other thing, a lot of the other emerging markets are very heavily commodity based. When you think about South America, Eastern Europe. So, right now, with oil prices struggling a bit, it doesn't seem like those are great places to be, since they're completely tied into a lot of the commodity infrastructure. So I think that India gives us a really fast-growing company. It's bringing in tons and tons of of jobs. As companies are leaving China, India is kind of the next stop in a lot of that. So I mean, if I had to put money into stocks and I couldn't touch it for 10 years, I think that you're going to see that international will probably outperform the U.S. strictly based on valuations. Certainly things could change there, wars, all that kind of stuff. If the Ukraine war blows out into something bigger, that's a big factor. But I mean, if you look at it strictly from valuations, I do still think that international is going to have a pretty good run relative to the U.S. just due to cyclical natures of the world. Did we just hear all that at the beginning of the webcast? Maybe there was I'm not sure what you're talking about. Maybe it repeated or something. You gotta love technology until you don't. So maybe part of mine just repeated. So I'm not sure on that. But anyway, so yeah, today was just sort of hitting a few questions that I got. No bigger issue. I do have, like I said, I've got some other interviews coming up talking about India. I'll probably play that next time. Also going to have an interview or discussion with Cale Smith, the new partner of Bastion Fiduciary, and we're just going to talk a little bit more about the company in general. I'll let you know right now. So it's been slow getting the move to the Goldman Sachs. I've been getting a lot of clients, their contracts re-signed to go to Bastion. If you haven't gotten that, you're going to get that very soon, probably this week. And then we have to do paperwork for Goldman Sachs. For most people, there's a few that we can't move. But we have to merge. We both use a customer database called Advizon, and we have to merge those two before we go to Goldman Sachs. So we're trying to get all of that, make sure that that's done well. I'm thinking that the final database conversion is going to happen next weekend, so we should be good at that point. If you do log into Advizon or even the planning software, Right Capital, they may be off for a couple of days. They told me it takes a little bit of time for that to repopulate. So if next weekend and even early into Monday, Tuesday, the following week, you may see some error messages. Don't freak out. That's going to happen with this conversion process. But then once we have the databases merged and aligned the way they should be, then it should be all set. So I appreciate your patience on it. I know I've been talking about for so long. We're excited to get it finished as well. But I'm going to do a chat with Cale, and we'll talk about just how everything's going to function and what we're hoping to achieve. So everybody have a great weekend, and we will talk to you soon. Take care, everybody.